Well, good morning, class. It's Wednesday morning, and I had gone through the reflection posts this week, and one of the frequently mentioned topics, and there were a few, was coverage in Chapter 11, the corporate reporting and analysis, which is basically the equity portion of your balance sheet. Questions about stock transactions came up, and I did post some information about stock splits, I think, and some other basic information. But the one area I want to point out and reinforce with the class is your textbook is a great resource. And so I'm going to be talking about the Need to Know 11-5, which is on page 434 to 435 of your textbook. That's 434 to 435. So this is a comprehensive problem. You could be asked a question that would only give you a portion of this, of course, and they could just ask maybe something that's a recall type question, or they can actually ask something that requires you to apply something. So we're going to take a look at this here, and it says Barton Corporation began operations on January 1st of 2018. So we have a start date for this company. The following transactions relating to stockholders' equity, that's the section of our balance sheet, occurred in the first 2 years of the company's operations. So we're going to be looking at startup through the beginning of operations, the first 2 years of this company's existence. And we're only going to be looking at the transactions that involve the equity side of the balance sheet. So in 2018, we've got 5 different events that occurred between January 1st and January 5th. And then in 2019, we had a single event that occurred on June 4th. So let's take a look at each one of these individually. First, let's take a look at the January 1st. It says authorize the issuance of 2 million shares of $5 par value common stock and 100,000 shares of $100 par value 10% cumulative preferred stock. So I'm going to stop us right there and make sure that everybody is well grounded in what those transactions mean. First, authorized just means the company has made those shares available. So in essence, if you think about it, is there anything here that needs to be recorded in the accounting records? Your answer should be no, okay? Because at most, this would be a notation in the balance sheet itself, indicating in some kind of maybe a parenthetical note that there were so many shares authorized. And of course, when we get to talking about issued shares, that's different. That is involved an actual transaction. Authorized is a decision, issued is a transaction. Okay, so they issued 2 different types. They issued common stock and preferred stock. The difference between the two, there's a legal definition that explains the difference between the two, but I'm just going to give you the common, my Dr. Gabrini's, real simple. Common stock is common because it's the most frequently traded stock. Okay, it is your rank and file stock. It's the blue collar stock that's out there. It's the stock that holds the greatest amount of risk. Okay, if the company was to liquidate and they put everybody in a line in terms of order of preference for getting something back out of this company that is being liquidated, the common stock holders, all right, they're at the end of the line. There is nobody left after them. Okay, frequently they do not get anything back in a liquidation. So they take on the greatest amount of risk. Preferred stock, well, they get a little bit ahead in the line. They're ahead of the common stockholders. And a couple of things about that is that with $5 par value, and the par value is just the stated value. So oftentimes it could be no par stock, right, which doesn't have a stated value, and so they might impute a value on it, like a penny or something like that. Or you have par value or stated value stock. So par value is just a term they use. It just means that each share of stock is initially stamped at $5 per share. That is not the amount that it's going to sell or trade for. It's just a measurement tool. Okay, and we'll see how that works. They don't tell you here, like over in preferred shares, they tell you that it's 10% cumulative preferred stock. What that description there is okay, it's preferred stock, it's cumulative, and the amount is 10%. So that 10% is applied against whatever they've purchased. So if it's $100, they have one preferred share, $100, then their dividend is 10% of that $100. And it's cumulative, meaning that if the company doesn't pay it this year, then next year they not only owe them their dividend next year, but they also owe them the dividend from the prior year. And so until they actually start paying the dividends, it will continue to accumulate. And the interesting thing about these transactions is that common stockholders, again, are at the back of the line. And so until the preferred stockholders are satisfied with their dividends, the common stockholders don't receive anything. Okay, so again, they're at the back of the line. They've assumed the greatest amount of risk. So that's kind of the way that works. So, all right. So let's go to number 2. Number 2, January 2nd, issued 200,000 shares of common stock for $12 cash per share. Okay, not uncommon. Okay, the par value of the stock really doesn't have a lot to do with what the stock is going to do in the marketplace. When the companies are getting ready to go public, one of the things that happens is they try to work up a frenzy about it because they want people to bid up the prices of the initial offering of stock. Because when they initially offer the stock, that's really going to determine the amount of capital that the company is going to have when it first goes public. And of course, the goal is to acquire as much capital as possible. And so they want that share price to go up because that's the market price. So the initial offering was at $12 per share, and so they sell all 200,000 shares of that common stock. So all gone. Now, again, they authorized 2 million shares. They issue 200,000 shares. So that means that they have 1.8 million shares that are authorized and not yet issued. So they've got 200,000 shares issued at $12 per share. They've got 1.8 million shares authorized but not issued. And that's $5 par value. We now have a value on the shares of the common stock that have been sold. So those 200,000 shares of common stock that were sold, they were sold at $12 per share. So the way this would get recorded is that you would have an account for common stock. And so the common stock account would record the number of shares at par value. So we'd have the 200,000 shares times $5 per share. And so that would be $1 million. So $1 million would be recorded in common stock. Now, the price that they actually received for the stock was 12. And so the difference between the price paid versus what the par value was happens to be $7. And so this would be $1.4 million that would be recorded in additional paid in capital. So you've got two accounts that you're dealing with here. You're dealing with one account for the common stock at par value, and another account called additional paid in capital that will be where the balance of the transaction, whatever they receive above par value, that's where it'll go. It'll go into additional paid in capital. Now, if this had been a situation where there was no par value or no stated value on the stock, then all of it goes into a single account. There's no need to have the two separate accounts. But since a lot of stock has a par or stated value, you will see two different accounts in the equity section of the balance sheet. One to record the base common stock at par value, another one to record the shares value above that par value, which is essentially what did they get for it. So what was the over and above? In this case, it was $7 per share because 5 plus 7 equals 12. Okay? So then you go to number 3, January 3rd, and it says they issued 100,000 shares of common stock in exchange for a building valued at $820,000 and merchandise inventory valued at $380,000. And so we've got this $100 par value preferred stock, 100,000 shares. So this is all of their preferred stock is being issued here. Or no, this is the common stock. So I'm sorry. So we're looking at more common stock. So 100. Remember, we had 200,000 shares issued initially for cash. So we had 1.8 million that we were still holding on to. So now we're going to issue another 100,000 shares, and this time it's going to be for some physical property. So now we have 1.7 million shares issued, but we have 1.7 million shares of common stock authorized but not issued. We had 200,000 shares issued for cash payment. Now we have 100,000 shares issued in exchange for some other assets. And so these other assets are valued, and these would be fair values. The building, 820,000, the inventory at 380,000, so you would add that together. That becomes 1.2 million, I believe. Yes, $1.2 million. And so, since again the common stock was valued at $5 per share, that was the par value of the stock, again there's going to be a difference. Okay, and so the difference here is going to be the difference between whatever the 1.2 million over the 100,000 shares happens to be and the $5 par value. Okay, and now you've got assets, and those assets are now fixed assets or capital assets that are going to be recorded on the books. So you're going to have $820,000 in a capital asset being recorded under buildings, and then you're going to book merchandise inventory in the inventory account. So that's a current asset, $380,000. Okay. Number 4, January 4th, paid $10,000 cash to the company founders for organization activities. And so this is a payment or a distribution to the owners. This is supposed to be for, I guess, services rendered. Then number 5, January 5th, you have issued 12,000 shares of preferred stock for $110 cash per share. So again, the same thing. You've got $100 per share preferred stock being issued at $110 per share. So you have both the base amount of the stated or par value of that preferred stock plus an additional $10 per share that is the additional paid in capital. And then finally on June 4th of 2019, they issue 100,000 shares of common stock for $15,000 cash per share. So same thing, it's $5 common stock, so you're receiving $10 per share more than the par value. So you're going to be recording this transaction again in your common stock account and increasing another 100,000 shares issued, and then you're going to have more additional paid in capital that you're going to record. So all of these problems will usually have a required section. And so here's our required. It says prepare journal entries to record these transactions. Prepare the stockholders' equity section of the balance sheet as of December 31st, 2018 and 2019. Prepare a table showing dividend allocations for 2018 and 2019, assuming Barton declares the following cash dividends. In 2018, they declare $50,000. And in 2019, they declare $300,000. And then 4, prepare the January 2nd, 2018 entry for issuance of 200,000 shares of common stock for $12 cash per share if A, common stock is no par stock without a stated value, and B, common stock is no par stock with a stated value of $10 per share. So number 4 is kind of a variation. Let's change the facts up a little bit, and we'll go ahead and see what this looks like. And so, again, the one nice thing about these problems, these pre-built problems that are laid out for you, is that kind of gives you a step-by-step of what you're going to need to do. Okay? So this is your plan of attack for the problem. So let's take a look at the solution. So again, we don't have a January 1st transaction. Okay? There's no transaction on January 1st. And why is that? Because authorization is not something that we record on the books. But we do start recording the sale of the stock. So we issued 200,000 shares of common stock. Okay, again, we issued it for something greater than its par value. It was $12 per share. So we record the full amount of the cash received. It's a debit of $2,400,000. And then for common stock, this is our one account, all right? Common stock, $5 par value. It's $5 per share times the 200,000 shares is going to be $1 million. So that's what gets recorded in the common stock. It's a credit. Again, because it's an equity account, it is a credit balance account. So we debit cash and we credit the common stock account. Now the $7 per share, which is $1.4 million, okay, that's going to go in paid in capital in excess of par value, common stock, okay? And so we credit that $1.4 million. And so that transaction is finished. That is a completed journal entry for that first transaction. Now the second transaction, again, involved common stock, but this time instead of receiving cash, we received some assets, other assets besides cash. So in here, we're going to debit the building. Okay, we have a building account in our capital assets, and so we record the building at its fair value of $820,000. Then we record the merchandise inventory, which again is a current asset, and we debit that account $380,000. Again, common stock is still $5 par value, so it's 100,000 shares at $5, so that's $500,000 that is going to be credited to the common stock account. And then because we received $1.2 million for this stock, we received $700,000 more than its par value. And so therefore the paid in capital in excess of par value common stock will be credited with $700,000. In terms of the payment to the owners of the company, okay, the founders of the company, they have to recognize some expenses, okay? So the organization activities that they participated in, it gets debited as organization expenses, $10,000, and then they credit cash $10,000. So it doesn't really have an impact on the equity portion of the balance sheet. It records something that is going to show up as an expense item on, say, the income statement. And then over here, we've got something that's going to affect our current assets. We see a reduction in cash. Now, on January 5th, we begin to work with the preferred stock. So we have here that we issued 12,000 shares of the 100,000 shares of preferred stock. Remember, it was $100 par value, and it was 10%, and it did accumulate. All right, so, or was cumulative. So what did we get for the stock? Well, we were paid in excess of it, okay? So we received $1,320,000 in total. That's how much cash that we received that's going to go in the cash account. But what we record, again, similar to common stock, is in our preferred stock, we only record the par value. And so we multiply the $100 times the 12,000 shares. We get $1,200,000. That's going to be a credit into the preferred stock account. The rest of it, okay, the $120,000 that was over and above, that's going to go into our paid in capital in excess of par value. Notice this account is a separate account from the one that we set up for common stock. So we have two paid in capital accounts, one for common stock, one for preferred stock. Okay, and so we have $120,000 credited to that account. And again, equity accounts have normal credit balances, which means that credits increase what's inside that account. All right, so what happens on June 4th? Well, we sold more stock at $15 per share. So we show an issued 100,000 shares of common stock. And so we received $1,500,000 in cash for that. Of course, again, in the common stock account, we're only going to be recording $5 per share, which is $500,000. The balance of $1 million is going to be recorded in the paid in capital in excess of par value common stock. All right. So that's the recording of the journal entries. So the second part of this was to prepare the stockholders' equity section of the balance sheet as of December 31st, 2018 and 2019. All right. So let's take a look at requirement 2. And here's what we have. So we've got 2018 and 2019. Notice this, when you're setting these up, the current year is always the first column, and then it works backwards. It is somewhat counterintuitive. A lot of people want to start off with the earliest year and then work backwards to the current year. It goes from the current year and works backwards. Just having some coffee here. All right, so again, what we do is we have our preferred stock listed first here, and so we have what has been issued and then the paid in excess. All right, and we just pull this from the journal entries. And again, you can take these journal entries here and turn them into T accounts. That's really easy to do. You would have a T account for cash, a T account for the common stock, a T account for the preferred stock. You would have a T account for the paid in capital for common stock, and a paid in capital for the preferred stock. And then of course we would have an organization expenses T account, and we would have a T account for buildings and a T account for merchandise inventory. And so you can put all this into the T account format, which sometimes makes it a little easier when you're putting statements together. And so here we just have our accounts listed. We've got preferred stock with its paid in capital, okay? And then we have the total paid in capital line summarizing it. Then we have the common stock and the individual transactions that occurred between 2018 and 2019. And then the paid in capital account. So we have a total paid in capital by common stockholders. So that's kind of the summarization, and then we have our total paid in capital. So this is the way that it gets organized, and all you're doing is pulling together and summarizing the information that's occurred up in the journal entries. And again, we divide it up between what goes into the individual stock accounts, what's going into the paid in capital accounts, and then within the common stock account, because we had transactions that crossed over 2 separate years, we actually break that up and we show the transaction amounts that occurred or summarized in those 2 particular years. So it adds to a level of transparency to the readers of the financial statements by doing it that way. All right. So number three said prepare tables showing dividend allocations for 2018 and 2019, assuming Barton declares the following cash dividends. So for 2018, they declared $50,000, and then in 2019, $300,000. Okay, so let's go to 3 and take a look at that. What we see here is, again, we have a column for common and a column for preferred. And remember what I told you, preferred shareholders need to be paid first. And so we look at it, we remember that it was 10%. It was $100 par value at 10%, and it was cumulative. So there is no prior amounts because this is the first year. So we have 12,000 shares outstanding at $10 per share, okay, because $10 is 10% of the 100,000, okay, is $120,000. Now remember, we only declared $50,000 in dividends. So that means the preferred shareholders will get all of it. Not only will they get all of it, but they are also owed $70,000. We must keep track of that, okay? So at this point, common stockholders are going to receive nothing, okay? So the total for the year was the $50,000 that was declared, and it all went to the preferred common stockholders in satisfaction of what we owed them as their 10% annual dividend. And again, we still owe them $70,000, which is going to come out of future declared dividends. So then we move down and we see that they declared a dividend in 2019 of $300,000. So again, we come up to the preferred stock first, and we have some dividends in arrears. That's what they call it. When they owe dividends based on a past year, it is called dividends in arrears. And so we have $70,000 that has to be paid out to them for that. And then in the current year, again, it is $100 par value. So $100 par value meant that for the 12,000 shares issued, you were dealing with $1.2 million and we take 10% of that is 120,000, and so we are going to issue $120,000 in dividends to the preferred stockholders again. So they receive their 2018 arrears amount of 70, plus they get their current year amount in full, $120,000. So they are going to receive a total of $190,000. Now remember, the dividend that was declared was $300,000. So the good news for the common stockholders is in year 2, 2019, they are going to be able to get a dividend. So they have 400,000 shares outstanding and $110,000 in dividends for that common stock. And so that's what's going to be issued. And again, you can also look at it as a per share amount if you want. So you could take the 400,000 shares and divide that into the $110,000, and you'd be able to come up with what the amount per share happened to be. All right. Part 4 on this problem is asking about some hypotheticals here. So we prepare the January 2nd, 2018 entry for the issuance of 200,000 shares of common stock for $12 cash per share, but we have an assumption. The assumption for A is that it's no par stock without a stated value. Assumption B is it's no par stock with a stated value of $10 per share. So how are we going to record it? How is that recording going to look different than what occurred here? So you can go back and you can take a look at the journal entry here and see, again, remind yourself that we received $2.4 million in cash, that we put the par value in the common stock account, so that was $1 million, $5 times the $200,000 share, 200,000 shares, and then the balance, the $1.4 million above par value, was put in paid-in capital in excess. So then what happens if we have this new scenario here? So we're going to take a look. And I guess I have to adjust my screen a little bit. All right, so there we go. So we're going to take a look here. So for 2018, no par stock without a stated value. We debit cash for the $2.4 million, and everything goes into common stock, no par value. So we do not have an additional paid-in account because there is no par value on the stock. So all of it goes into the common stock account. Again, it's an accounting fiction, if you want to call it. In one case, since we have a par value, we only record par value in that account. The rest of it goes into a paid-in capital or an additional paid-in capital account. Here, because there is no stated value or no par value, it's all going to go into the common stock account. Okay, it is helpful for record-keeping purposes to keep track of what you issued at par value and what did you receive over and above. There are reasons why you want to keep that separate, okay, but it's not always necessary. It depends on the circumstances for the company. So B, for 2018, what if it was no par stock with a stated value? Stated value is $10 per share. And so how does this change things? Well, we still debit cash for the full amount, $2.4 million. But for the issuance of the 200,000 shares, we now have $2 million. $10 times the 200,000 shares is $2 million. And so that's what's going to be credited into the common stock account. The balance of $400,000, that's going to go in paid-in capital in excess of stated value for a common stock. And so that's the way that will work. So fairly straightforward transactions. Again, they're going to be foreign because you haven't seen them before. And so for anybody that had any struggles with any of this, again, when you have to think about it, just taking a step back, what is the purpose of all of these transactions? It is to raise money to operate the business. All businesses need cash in order to be able to run. And so where does somebody or some group of people, where do they get cash for a business? Well, one place is they can put it in themselves. So if they have personal cash holdings, they can liquidate it and they can give it over to this new business in the form of a contribution. Okay. They can also contribute property as well. Okay. And again, that would be recorded at fair value to the business. Okay. The other thing that they can do is they can go ahead and go public, and that would allow them to sell shares on the marketplace. And the other thing that they can do is they can acquire debt. They can go out and take out loans, or they can sell bonds to try to raise capital for the business. That said, all of this occurs in what we call the financing portion or financing section of our financial statements. Okay? All right, so I'm going to end this here. It's about 30 minutes, and I've kind of talked through this problem. Hopefully you'll find this helpful. If you do have any other questions, please feel free to ask. I'm always willing to field questions from you guys.